Welcome to Bar Chart's weekly webinars, where we at Bar Chart hope to educate you on a variety of trading and investment concepts, inform you about the pages and tools Bar Chart provides related to these ideas, and finally, to offer you some food of thought to help you make a more informed investment decision. Today's subject, 2022, new year, new trends. So I really believe that 2022 will be one of the most challenging years for stock pickers in over a decade. And that's because of a myriad of cross currents between these emerging trends. Hello, everyone. My name is John Rowland, and I'm Bar Chart's head of trading education. Today, we're going to look at some of these emerging trends and the sectors that seem to be benefiting from them. We'll look at some clues that the market is telling us, and if they're predicting a change in the economic cycle or business cycle, and or is it forecasting a potential recession. And then finally, I'm going to offer you my 22 stocks for 2022 based on these emerging trends and the clues the market is generating. But before we get to that, please welcome my partner and our moderator, Bar Chart's project director, Jean Baker. Hello, Jean.
Good afternoon, John. How are you?
I am fine, and how are you today?
Doing great, thank you.
So, Jean, what is your emerging trend of the year?
My emerging trend for the year. So we were briefly talking about this before we came on air. I was saying how I guess I need to get more in tune with installing some of the smart devices around my home. You know, let somebody else turn the lights on and off for me. Start my oven remotely. Things like that. That's my thing that I'm hoping to do for 2022.
Well, it definitely is convenient, and it makes for life a lot easier. So I kind of agree with you on that one. All right, let's jump into it. So today's session, as always, is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or other investments involves risk and invest based on the advice of qualified financial professionals. And today I will be sharing you some of my ideas about particular securities, and this should not be construed as an endorsement or recommendation, right? And under no circumstances shall we be liable for any losses or damage you or anyone else occurs as a result of any trading or investment activity that you or anyone else engages in based on the information or material you receive through barchart.com in our services. Okay. So before we jump into emerging trends, let's go and revisit what happened last year. And hang on a second. Oops. And if we look at our sectors from last year of the S&P, we can see that energies and real estate were the top performers over last year, but all 11 sectors were up, and below the energy and real estate, we have financials, information technologies, communication services. They perform pretty well. In the middle, we have consumer discretionaries, consumer staples, and then our laggards were healthcare, materials, and utilities. But overall, it was a pretty good year for the S&P. All sectors were up. But let's take a quick peek of what is happening now, and this might help us get a sense of what trends could be developing. So if we look at what has been happening over, let's say, the last 5 days or month or 3 months, you can still see that energies is one of the top performing sectors. Next to energies, we continue to see that financials is still one of the better performing sectors. Notice that consumer staples the last 3 months or 1 month has been doing pretty well. Now, in the last day or so, last couple of days, it has had a little bit of a pullback. Now, that might just be because it's having a pausing or a brief moment of consolidation, but still pretty decent returns over the last month and 3 months. All right, so what are some of these emerging trends? Well, first of all, I believe that you're going to see a continuation of rising energy costs. This shift of production from domestic to outside the U.S. or a reliance on OPEC, for instance. Also, part of this trend is the redistribution of capital from our large oil companies, right, moving away from exploration and production and moving towards alternate energy sources. But also that capital is now being put to use in terms of maybe dividends or share buyback programs. And also the continuation or the reemergence of demand, this elastic demand for energy, especially as markets become more normal. So I believe that you're going to see energy prices continue to go higher, which is, I think, will be beneficial for the whole energy patch. Inflation. Well, inflation, I believe, is going to be a macro trend. It's going to be the most influential trend for this year. So inflation will be both positive for some sectors and stocks, as well as negative for others. We want to concentrate on those sectors or stocks that will have the pricing power to push through cost increases to their customers. And in other words, for example, I want to look at those industries or sectors that are at the beginning of the supply chain. For instance, manufacturing raw goods or base materials or input products, similar to oil or fertilizers for farmers and grains and such. But inflation is going to have other effects on the markets or sectors. And what sectors will those be? So we're going to look at those sectors that will benefit from a shift in consumer habits. If we talk about inflation in terms of cars, and we look at what is going on in the used car market currently, a used car averages around $29,000. And the first time ever in history, a car that was purchased 3 years ago is actually worth more today. And if you look at, if you haven't tried to buy a new car, there's a limited supply of new cars. So consumers are holding on to their cars longer, right? They're taking care of them. Tires, shock absorbers, oil changes, i.e. auto parts. So here is a chart. This is AutoZone, by the way, which was one of our charts of the day. And what I've done here is I've turned this into a percentage gain, price percentage, and I've added 3 other auto part makers, Genuine Parts, Advance Auto, and O'Reilly. And you can see since about September of last year, all of these have started to perform well. This is a trend, I think, that is going to carry out through the next year or so. Now, one little tip here is when we're doing some comparisons between multiple stocks or multiple inputs, make sure you change your chart to percentage scale. If you don't do that and one of your stock prices is out of line, maybe it's very, very expensive, you don't get that performance from this comparison. Notice that AutoZone is a $2,000 stock, which the other ones are in the $100 to $200 range. So, we want to make sure that one of the cool things we can do is do it on a percentage change basis, and you get a little bit better benefit from that. All right. But let's also think about consumer spending in terms of at the retail level. So a shift from frugal from luxury goods. And in the grocery store, moving from filet mignon to French fried potatoes, so to speak. A second macro trend that we can start thinking about is the Federal Reserve's shift from accommodation, quantitative easing, to tightening. Now, Chairman Powell has repeatedly said that they're going to taper first, then tightening. So this is going to be difficult. Timing-wise, it's going to be difficult to know exactly how they're going to do this process. But tapering, or the removal of easy money, will have an adverse effect on these high multiple, high valuation growth stocks, and tightening should benefit value stocks. What makes this trend difficult is, will Powell let the market tighten for him and keep short-term interest rates low and risk a greater inflation? Or will he be forced to quickening his tightening to curb an out-of-control inflation? Now, my bet, being it an election year, and in my experience, the Fed doesn't raise rates in election years, I think Powell will be slow to tighten, which means then I think you'll see more inflation this year, and those sectors that will benefit from inflation will be ones that we want to keep an eye on. But let's kind of look at what is going on in terms of interest rates. So right here again, I have the 10-year note up. It's the 10-year note yield, and I made this chart a percentage change chart. And the red line is our 2-year note yield. The orange is the 5-year note, and the blue is the 30-year note. And what you can notice here is that the yield at the short end, the 2-year, is rising faster than the yield at the long end. And this is a sign of a flattening yield curve. Now, historically, a flattening yield curve is a sign of recessionary possibilities. But I'm going to just change this chart to another chart, same concept here in terms of yields, but what I added was this green line is the S&P's financial sector, and we did see that financials is one of the sectors that is performing, and certainly financial stocks will do well in rising interest rate environments, but in steepening yield curves, in other words, longer term rates rising faster than shorter term rates. And we're seeing the opposite in terms of interest rates right now. So the question now becomes, is the market actually telling us or betting that Powell will be slow to tighten, and that will create this steeper yield curve? Now, only time will tell, but certainly the financials is one of those sectors that has in recent been doing quite well. So what are some of another trend that we can think about? Well, that 800-pound gorilla in the room. How are governments and industries going to deal with or adjust to if there's a change in public health as it looks to control the coronavirus? Now, some of these are unknowns if we have new variants, but some of the things, for instance, vaccinations and boosters, right? Are we going to continue with that process? But I think some of you are familiar with the Supreme Court is now hearing rulings on vax mandates. And if they strike down vax mandates, then will health officials choose a different path, maybe more testing? Certainly in my experience, I'm seeing a lot more testing showing up around me. Matter of fact, one of our colleagues at Bar Chart was on a cruise, and not only did you have to be vaccinated, but you had to be tested before you went on the cruise. But when they reached their destination, they also had to be tested before they could enter that particular island. Maybe changes in masking or masking mandates. Maybe as the science comes in, that cloth masks aren't as effective as maybe more stringent masks, maybe like the N95, or maybe a moving away from masking. So we can think about this in terms of the actual what is going to happen with the coronavirus, but also I think we want to also think about what effects it will have on economic activity. Do we see lessening of restrictions? Maybe folks will be more comfortable traveling. Maybe folks will feel more comfortable going to restaurants. Maybe folks will be more comfortable going back to the workplace, and that could ease supply chain issues or help alleviate inflationary pressures based on employment or wage inflation. So these are some of the trends that could emerge this year. And as these trends emerge, well, we're going to start seeing something called market rotation. And what market rotation basically says is that there's a movement of money in our stock market from one sector or industry to another as investors are anticipating a change or a new phase in the economic or business cycle. And this is this ongoing process that investors are always looking at. Value versus growth, right? Are my earnings increasing, or have the price of my stock gotten too rich and its valuations are too high? Where is there value in the market, and where can I expect earnings expansions? Right? Now, the stock market is always looking forward. So when we talk about what's going on today in the stock market is actually looking 12 to maybe 18 months forward. So again, as we look at some of these sectors, we could be getting clues to what the market is thinking is going to happen, maybe, some part at the second half of this coming year, or looking into 2023. But changes in the economic cycle or business cycles of individual sectors or stocks are just reactions to changes in corporate profits, credit availability, inventories that are unsold, employment issues, and again, monetary policy. And these are all variables that we just have mentioned in terms of some of the trends that we're starting to see. So if we look at the economic cycle, there are certain sectors that do outperform other sectors during the different economic cycles. For instance, in the early cycle, typically after a sharp rise, we see a sharp rise after a recessionary session, consumer discretionaries, real estate, finance. So if you think about last year, real estate was one of the outperformers, and the previous year we did have recession that was a reaction of COVID. But again, I think this is more of a dynamics of demographics in terms of folks that were living in cold states that were moving towards warm states. And certainly in my personal experience, I moved from Pennsylvania to North Carolina. But financials, right? Maybe we weren't in a recessionary cycle last year, or certainly a lot of corporations did very well last year. But financial stocks could have been in a recessionary cycle, right? Banks, right, because of low interest rate environment. So now we're seeing a change in that. So they could be in the early stages of their economic or business cycle. Mid-cycle, we see information technology, semis, industrials. Late cycle, economic activity surges or peaks, but corporations warn of headwinds and slowing growth. And if you were paying attention to what was going on in the earnings season in the last part of last year, many corporations were telling you that they had record profits or record earnings. And yet they were also saying that looking forward, they were starting to see inflationary pressures, input costs, in labor costs, and that they were warning that their earnings might not be as profitable as they had been in the past. But we see energies and utilities are those two sectors that tend to outperform in late cycle. And certainly energy was one of the sectors that outperformed last year. And then finally, we move into what is called the recession cycle. Excuse me. Economic activity contracts, profits decline, and recessionary cycles tend to last a few more than just a couple months, maybe 8 to 10 months, sometimes maybe more than a year. And those sectors that perform well in a recessionary cycle are consumer staples, healthcare, and high dividend yielding stocks. So let's go to the tape and let's see if we can find out what sectors are outperforming and see if we can connect them with our trends and our economic cycle. So here is our stock market and sectors performance page. And what this is showing us is the percentage of large cap stocks above their moving averages. And what we can see here for the S&P energy sector, 100% of all the stocks that are in that sector are above their 5-day, their 20-day, their 50-day, 100-day, 150, 200-day moving averages. And when we think about moving averages, price tends to stay above a moving average in an uptrend. So what we're seeing here is that energies is showing us that it is in a strong uptrend through all time frames. But also we can look at what other sectors are performing well. Certainly financials. Again, we can see that about 80% of all the financials are above their moving averages. If we look at, for instance, consumer staples, in recent days, we see only about a third are above their 5-day moving average. Now, I'm not concerned about that. Could be just a short-term correction. But if I look at 20-day all the way to 200 days, again, a large percentage, over majority of the consumer staples are above those moving averages. One other way we can use this grid in helping us to find what sectors might be moving in a positive direction or gaining momentum is we can look at the difference of percentages from longer term to shorter term. So for instance, look at communication services. Here what we see in the longer term moving average is that a majority of stocks are actually below these. In other words, here it says only 30% or about a third are above their 100 and 200-day moving average. That means 2/3 are below. That is typically a bearish indication or a sign that those stocks could be in a downtrend. But in the short term, what we're seeing is that the 5-day and the 20-day, now we're seeing a greater number of stocks above those moving averages. So what this is indicating to us is in the short term, this sector is gaining momentum. Maybe it's starting to turn around. This could give us onus to start investigating this particular sector, maybe looking at the stocks that are in there and seeing if they're benefiting as well from whatever trends we are discovering. So this is one way we can use this grid, not only to identify which sectors are strong and are trending, but also which ones that could potentially be changing trends or gaining momentum. All right, so what I want to do here is let's go a little bit more granular in terms of our sectors. And what I've done here is I've gone to, in our stock section, our industry heat map. And if we look across the top here, we can see oil, 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 right? We know that, we've seen that oil and energy has been one of the outperforming sectors. But we could go inside of each one of these sectors and look at individual stocks that are in that particular sector. So what's a nice little feature here is, first of all, right out here on the top, what we see is called something called the average weighted alpha of all the stocks in this particular sector. Now, what this is telling us is how are these stocks performing? Now, when we talk about weighted alpha, is how much a stock has risen or fallen over a 1-year period with a higher weighting towards recent price activity. Now, we can see from left to right that our alpha has been continuing to rise in terms of this particular industry sector. But at the end of the third quarter last year, we did see a little bit of a correction in the energy markets. But in recent months, recent weeks, we do see that the average alpha is now rising. Again, momentum is coming back into this sector, and maybe this trend is going to continue. But if we look at these stocks in terms of their 52-week percentage change, you can see that a lot of these stocks have had some really extraordinary gains over the last 52 weeks, right? So maybe a long in the tooth trend, but certainly a trend that is continuing. If I go back to the heat map and I look at some other sectors or industries that are performing well, one of the ones that we noticed in our first analysis was consumer staples. And again, when we look at the weighted alpha here, we can see that we see a little bit different story than what we saw in the energy sector. Matter of fact, since about mid of last year, the consumer staples sector had been falling in of its weighted alpha. But we do see a nice V bottom here. Something changed that made consumer staples more attractive, and now we see their weighted alpha rising. If we look at our 52-week performance of a lot of these stocks, we're not seeing those extraordinary gains like we saw in the energy market. And if I look at this on a performance basis, 52 weeks versus, let's say, 1 month, we can notice that a lot of these stocks gains have been coming in the last month or so. In other words, this sector is starting to attract money and is starting to gain greater momentum. Now let's go back and look at the heat map one more time. And this was kind of curious to me as I saw that under the transportation sector, airlines, we do see that in the last month, airlines has been up 5%. But again, part of our process of investors is we have to do our due diligence. And if I do my due diligence on this one, especially when I'm thinking about the trends that we just talked about, rising energy costs, that is certainly a problem for airlines, oil prices, and wage inflation, right? Two headwinds. Don't mean to make a joke here, but for airlines. And we look at their weighted alphas, well, you can see their weighted alphas are negative. And that would be a sign for us that, hey, yeah, maybe this is just might be a dead cat bounce or just a small correction in a market or a sector that is still underperforming. And so in this point, I probably would wait for airlines to get into a positive weighted alpha. And I'm going to pass on looking at for opportunities in the airline sector. Now, some of you might say, well, John, we've looked at these different sectors. How can I take advantage of them? Maybe I'm not granular in the respect that I want to look at a particular stock. But I can certainly go into ETFs and look for those ETFs that are reflective of those sectors or those trends that I'm seeing. So I just pull this up. This is our top ETFs to own. And let's just look at a couple that are up here. Here's an ETF that's based on inflation. Other ones here, value, right? Looking for maybe dividends, consumer staples, right? Now, there are some ETFs in here that are what we call leveraged ETFs. So what I can do is I come back in here. I'm going to eliminate all the leveraged ETFs, shorts and triple longs and double longs. And maybe I'll just do a simple price percentage change. I want to see those that have performed well over, let's say, the last month. And we do that. Again, what do we see? Dividend yielding stocks, certain different sectors. So this is one way we can sort of zoom in on those sectors or ETFs that would be in line with our analysis. But then again, some of you will say, well, I'm more interested in, I want to find the best of the best of the stocks that are taking on those qualities, those markets. So I can go to Stock Screener. I know what sectors or industries that I'm looking for, industry groups. We just discovered we liked staples, energies, financials, healthcare. Those are the trends that we just discovered. And that'll just give me a basket of those stocks. Then once I'm inside of that basket, I can start screening on them. Now, one of the benefits of a subscription for a bar chart is we can create custom screeners, and that's what I've done down here. I have one that's called 22 for 22. And inside of that screener, I've looking for those components that we said, looking for those companies that are going to benefit or be able to push through prices through their customers. So for instance, I have net income over last quarter. I want to see that their income is rising. I added short-term opinion. I'll show you that in a moment. That's our bar chart opinion based on technical analysis. But again, I want to look at operating cash flow. Again, I want to see a rise from quarter to quarter. In other words, if their cash flow is rising, that means they're able to push those prices through to their customers. And are these cash flows increasing over last year? So just kind of some simple fundamentals, and then filtering those down. Now, what I did was I did this process. I went through the different sectors. I went into each one of the different heat map industries that are performing well. And I started cherry picking out the ones that looked good to me. For instance, another benefit of being a bar chart subscriber is not only can I screen on the stock screener, but I also can create a custom view with certain inputs that I'm going to use in my analysis. And again, I just did the same thing that I showed you in the stock screener, looking for cash flow, operating income, rising earnings growth over quarter, and start picking those stocks that are in those different industries that are performing well. For instance, here, this one that has this 150% earnings growth over last quarter is Lamb & Weston. Now, we talked about this stock last week in our session, so if you're interested in about what that stock is about and what we found, I would recommend that you watch that session. But again, those that are having positive cash flows, right? You can see some of these stocks are doing very, very well in terms of their cash flow. And look at the companies that they are in the consumer staples: General Mills, Pepsi Cola, Hormel, Smuckers, right? Archer Daniels. A lot of very stable industries, very stable companies. So what I did was I grabbed all these together. I put them in a giant hopper, and then I started cherry picking the best of the best. And that takes us to our watch list. And this is the 22 stocks that I believe are going to benefit from the trends that I've just laid out for you. Now, full disclosure here, I have skin in the game, and of these stocks in my portfolio currently, I own Alcoa, Suburban Propane, Archer Daniels, Hormel, Global Medical, Church and Dwight, and Cheniere. But my fundamental process, my sector process, has now brought me to this watch list. And again, part of my process will be looking at other inputs in terms of maybe some technical inputs. But if I break this down in some of these different markets, I'm going to look at some technical analysis. For instance, let's start with Cheniere. Right, and this was one of those energy companies that has performed well over last year and has continued to perform throughout. But you can see that since about third quarter of last year, it did have a little bit of a consolidation, a little bit of a profit taking. That we saw that in our weighted alpha of our energy sector. And then we got this breakout, right? And so in technical terms, in terms of chart patterns, this is called a bull flag. This is a sign of a continuation of this trend. Some technical analysis folks will tell you the length of the flag could project how far that price could move. And so if we did that, this looks like we could easily get above 120, 125 over the next few weeks in this trend. That's a very common technical trend analysis. But the other thing that in my process is not just formations, but bar chart provides us an opinion in terms of technical indicators. And we can see that for Cheniere, the short-term indicators, 50% of them are buy, and that's really kind of showing us that that sideways action we just saw there. But the medium and long term, all of those indicators are 100%, and that is a sign of a nice, strong, and stable trend. Let's look at Smuckers. And let me go to a shorter period. Again, in terms of technical patterns, this one is called a cup and handle. Notice that our stock had come into an area of consolidation, basing action, is gathering energy, is trying to decide which way it wants to go, finally breaks out. It reaches a level of resistance, it pulls back, gathers more energy, and then breaks out. And actually, if you look at this, this is really a cup and handle inside of a larger cup and handle. And if we look at this from a higher time frame, a weekly basis, right, you can see that breakout that we just got. And again, we looked at this sector was one that in the last few days we've seen prices pull back a little bit. And I'm not concerned about that. It's just good, healthy for the market to have these impulses, gather energy, and then continue on its way. So this is definitely one of those price patterns that I will be looking for. But again, there's other data I can look at besides price pattern. Again, my opinion. And here you see for bar charts price opinion in terms of these technical indicators, all the short-term indicators are above or buy signals. Our mediums, 100% buy signals. Now the longer term is only half of them, and that is probably because it took a while for us to move out of that bottoming action. But again, there are other technical and fundamental things that I'm looking for. And so one of the other things that I've been kind of looking for in terms of trend, if I believe the market is telling me that there is a potential of some recessionary problems in the market, certainly dividends will be one of those stocks that I want to look for. And this not only tells me that we have good earnings growth quarter over quarter, but this stock currently is yielding 2.7% in terms of a dividend. And if I look at its profile, what does this company do? And I break that down, well, we can see that in the family of goods that they have, well, they have jellies, coffees, Folgers and Dunkin' Donuts, and Jif. And so if you think about that, peanut butter and jelly and coffee is certainly a recessionary diet. I'm just making a joke there, but again, pointing to changes in consumer spending habits, this is a company whose products might still benefit even though folks are changing their buying habits. And then I'm going to show you one more, and this is where sometimes we have to think a little outside the box. This is Suburban Propane. And again, when we looked at the energy sector, we said that the energy sector performed well last year, but is starting to gain momentum again since the end of last year. Now you can see that on this chart here that Suburban was not one of the energy stocks that performed well last year. Matter of fact, it actually went down last year. But we have a nice V bottom here. Again, a nice technical formation, pattern formation that I like to look for. A big change in price in a very short period of time. And now this stock is starting to move higher. But again, if I look at the other data, sometimes I have to think outside the box. If I look at my opinion indicators, right, not one that is showing me a lot of bullishness, right, still some negative trending here, but it is very weak on the sell side. In other words, we could be seeing a transition from a sell to a buy. But again, those fundamentals, and this is what kind of really attracted me to this particular energy stock, is now it's starting to show momentum. It's starting to get pulled along with the other energy sector stocks. But this stock also has an 8.5% dividend. So let's be honest about this stock. This stock is really less about an energy play. It's really more about a utility or dividend play. But there are some fundamentals that are in play with this stock that could help it outperform. And if we look at our profile for Suburban, it does business in 40 states in the United States. And not only that, but it services not only residential, what you and I use propane for, but commercial, industrial, and agriculture. And so the trend, the favorable trend for this one is many farmers over the end of last season, we had a big bump in grain prices over last season, but as we came to the harvest time, prices fell back. And a lot of farmers have held on to the grain that they harvested last year in anticipation. They believe that grain prices will rise this coming year, which I think they're right. But as they store this grain in silos on their properties, they need propane burners to keep that grain dry. And so what we've seen in the short term is an increase in demand for propane from the agricultural sector, where a couple of years ago, farmers were lean on inventories. That was probably one of the reasons why grain prices rallied over such a big proportion last year. But now we have a lot of storage of inventory for grains, and so those prices have stabilized, and yet our demand for propane could be reflective of those storage plays. So let's look at this one in terms of big picture. And again, this is a boring stock. This is not one of those stocks that's going to move around, $1, $2, $5 a day. This is a stock that is going to just creep along. And if I look at this in terms of a much larger picture, you can see that maybe I'm a little early to the game here, and we certainly haven't really broken out of that range that we've been stuck in for almost a year and a half. But if we think about that dividend, that 8% dividend, and we see price appreciation in the stock where that brings down the yield to more like its peers in the energy sector, let's say 4%, you can see that only a few years ago, this was a very boring stock that was trading between the range of $22 and $24. So, again, I think I'm a little early on this one, but a lot of things that I like that are adding up to make for this is a favorable stock. Okay, so I see a couple questions Gene's has pushed through for me, so let me take a moment here to read some of these questions. Any other questions that are popping up, Gene?
Not at the moment, John. No.
Okay.
This is being recorded. A few people have asked about that, and you will get an email later on today with a link to the recording, or you can always find it on our webinar archive page. But we'll go through that at the very end, where to find that.
Right, so there's a question here about higher dividend mean that the company needs to pay bigger amounts to attract investors. Not necessarily, it just means that the company has done well, has performed well, and it's looking at ways to increase shareholder equity, shareholder prices. But a higher dividend would mean that they would have to have more cash to pay out the dividend. So it's kind of a healthy sign. If your company is paying a nice dividend, it probably means that their business is healthy. Now, there are occasions where a high dividend could be cautionary, where maybe they might cut their dividend. But as long as their sector or their business is doing well, then and that dividend is paying well, I think you'd be fine on that one. Another question here from Danielle is there something about gold and other precious metals? Yeah, that's a great question. I did notice when I was starting to put this webinar together that was one of the sectors that has starting to perform in the very short period of time. You can see here we have gold miners. Again, we'll talk about inflation and the old adage that gold is, was an inflation hedge, and I think that gold has lost that inflation hedge in a very low inflation environment that we've seen over, let's say, the last decade. But things are changing, and now we're moving towards a more high inflation environment. And so I think that correlation might come back into play. So yeah, I think there's something there. I'm not ready to jump on that bandwagon yet. So Aaron asked me, is really like the section about industrial heat map. So he appreciates that. Thanks, Aaron. Thanks for the comment. Theodore asks about the operating income increase for Eastern Chemical. So again, A lot of these inputs that we're going to look, or fundamental analysis, might need some further investigation. Now, I didn't do that further investigation on this, but we could see one-time charges, or maybe there was they sold a part of one of their processing plants or something. There was a big capital gain, so that could be the reason behind it. You have to do a little bit investigation. That's why I don't want to really rely on just one input. I want to look at multiple inputs. Al asks, is there still runway for high flyers in 22 like tech, Apple, Tesla, Bitcoin? So Al, again, I think you have to think about in terms of rising interest rates and less accommodating Fed, and those high growth multiple stocks tend not to perform well in those environment. Now, it doesn't not mean that they can't perform over this coming year, but I think what we're seeing, and is very obvious to us, is that money is flowing out of those high tech, big cap tech stocks and is being redistributed in some of these other sectors. So I think I would wait for that early economic cycle before I start actually thinking about some of these high tech stocks. John Myers asks the impact of EV growth on traditional energy prices. Yeah, again, that's what I said. There's this shift from capital expenditures away from domestic production in the United States, or the old fossil fuels, into alternatives. And that is one of the reasons why we're seeing energy prices rise, is because the transition is not keeping up with the demand for energy. All right. So one final thought, or a couple thoughts here for you guys before we end our session today. Rapid changes in trends. This unknown variable, inflation, market uncertainties, and a less accommodating Fed means that investors need to be a little bit more realistic about expectations and returns this coming year. What we saw in the last year and a half or 2 years, I believe, will be a run of stock prices that we might not see again in our lifetime. Some of those extraordinary gains were a combination where the market had fallen very dramatically because of COVID, but also this quantitative easing, this injection of liquidity into the market has exacerbated these extraordinary gains that we've seen in the market in the past year and a half. And I think moving forward, without the Fed accommodating, we're going to go back to more of a realistic market where you see 25% or 30% or 40% will be a good return for a particular stock, and not saying these 400, 500, 2,500% returns like in the case of GameStop. Market uncertainty, right? Black swan events. Now, we can't predict things that we don't know that are going to happen, but certainly on the horizon, there are some geopolitical events that could occur. China with Taiwan, Russia with Ukraine, Israel with Iran. And if any one of those blow up, that could be very detrimental for the greater market. And again, inflation. We don't really know right now what inflation is going to do. Certainly, it is trending in the wrong way. It continues to increase. But if inflationary pressures slows down demand for goods, that could help alleviate some inflationary pressures. Certainly, a less accommodating Fed, less money being pumped into the system, is also a good way to lower or slow inflation. But in order to control inflation, if you believe in the theories behind, for instance, Chairman Volcker and Milton Friedman, the only way you can control inflation is by raising interest rates. And again, I believe that the Fed is going to be slow to raise interest rates, and they're going to see if let the market mechanics can help them out. So I think you need to be a little bit more realistic about returns this year. You got to be a little bit more nimble. Take your profits and run. Make sure you use good risk management when you set some of these trades up, when you pick some of these sectors, some of these stocks. And also remember, we're always thinking forward. We're not thinking about what's happening today. Let's look at what trends are developing and how far will they carry out. Okay, so I hope you guys enjoyed today's session and gave you some ideas, some foods of thought, some trends, and some investing ideas for this coming year. I want to remind you that there are a lot of benefits as for being a member of Bar Chart. Matter of fact, let me show you one other benefit I forgot about. For instance, on my watch list. Right? As a subscriber, I can have a certain number of watch lists. A premier member has an unlimited watch list. Gene, I believe a basic membership has 5. Is that correct?
That's correct, John. Yes.
Okay. So I have a watch list, and I want to start watching these stocks. Right? Well, what I can do is I can send myself an email. Maybe I don't have the time to look at these every day. I can send myself an email at the end of the day that is going to show me this watch list. But one of the other nice features is I can use that custom view of those inputs that are more important to me, be it performance, be it fundamentals, and I can keep an eye on that watch list. And I can send that to me based on either the default views that we create for you or a custom view of my own. So this is another great benefit of being a subscriber to Bar Chart. What else? Oh, I know. Next week, right?
Right. So as you go to the webinars page, I do want to point out to you that besides getting an email later on this afternoon with the link to the recording, John, go ahead to the archived webinars. This is where you're going to find the recording a little bit later on. You'll see it right there, 2022 New Year, New Trends. And John's slides, along with his screener and his custom view and his watch list, are available. So it says download slides. It's a PDF. You can download that, take a look at everything that John set up for you, set up your own screener, set up your own watch list, and go from there. So now, John, let's go and talk about next week then. Upcoming webinars.
Yeah, next week what we're going to do is, well, we're going to talk about bear markets. Now, I'm not predicting that the market is going to go into a bear market or that we are in a bear market, but maybe we can find some clues that some of our sectors or some of our small caps or large cap markets are in bear market. So we'll discuss what a bear market is. We'll look at the difference between uptrends and downtrends. And then what I'm going to do is going to give you some advice that if you are trading a stock that is in a downtrend or in a bear market, there are some little bit different ways that we want to trade those stocks or those sectors. Different from how we would attack, let's say, a bull market. And then what I'll do is maybe, if I have time, is we'll look at maybe some chart patterns. We'll do a lot of technical analysis, but we'll look at some chart patterns that might signify the end of a bear market, and that could potentially begin beginning of a new uptrend. Think in terms of that cup and handle that we saw in Smucker's. That is definitely a typical picture we find at the end of a downtrend or end of a bear market. That's kind of sideways, nothing's going on, building energy, waiting for it to break out. So I really think you're going to enjoy this one because I think there's a lot of investors out there over the last decade or so, or maybe a whole generation of investors have never seen a bear market or don't even know what a bear market is. And I think you'll enjoy that session. All right. Anything else, Gene? I think that's it, right?
I think that's it, John.
Okay. Well, thanks, Gene. And again, thanks for your trend ideas. I want to wish everybody to be safe out there, be healthy, and the good of all trading.